Welcome to another video by the Market Maker SA. I hope you are doing good. I hope you are trading strong. Before we continue, don't forget to like, comment, and subscribe. We're trying to hit 1,000 subscribers this year, so don't forget to like, comment, and subscribe. Don't forget to hit that notification bell icon as well. So without further ado, let us begin. Now today we have a very interesting video, very interesting video that I think you guys are gonna like a lot. Today we'll be looking at our externals and our internal liquidities. Now of course, before we continue, we first have to explain what exactly is external and internal liquidity. Now obviously, in the terms of external and internal liquidity, external liquidities are those liquidity highs and liquidity lows that we look for market to break for us to indicate that market has taken out significant orders to continue the cycle. And then of course our internal liquidities is of course in between that liquidity high and that liquidity low. We look for in between that high and low, in those points of interest. That's where we look for our internal liquidity. That's where we look for where the proper orders are, so we can identify where the orders are placed, and we can then follow the banks. We can follow the banks, we can follow the orders, because we can't compete with banks. We can't trade the opposite direction of the banks. So the only thing that we can do is we can trade in line with them. That's where we look for our internal liquidity. So very important there. So without further ado, let us begin. So obviously right now we are looking at Nasdaq, or more specifically we're looking at the E-mini future of the Nasdaq, the NQ1. And as you can see here, we had what we saw here. We had this very nice anchor formation. Obviously it was backed by this turtle soup formation, or liquidity sweep, because there are a lot of people who bought there and they were taken out. So obviously then market went down, then market gave us this very nice anchor formation, and then obviously market started the trend. Now obviously, how do you then identify, I mean in this instance, how do you identify your liquidity high and your liquidity low? Well, it's very simple, to be fair, because the first liquidity high that you look for to be taken out obviously is right here. Your first initial break of structure is the first liquidity high that you'll be looking for market to take out. Then obviously your liquidity low will be right here in this area. So obviously this will be your high, that'll be your liquidity low, that'll be your liquidity high. Now obviously now we're looking for the liquidity inside. Where could we find how do we identify, of course, whether banks have their pending orders? That's the liquidity inside. That's obviously the positive liquidity. Obviously in this instance, what market did, market rallied up before market even took out that area. Market was not going to take out that area before dipping into an area into a point of interest. And as you can see, market went into this fair value gap very nicely. Market came into it, pinned twice of its first leg, second leg. Market ran away, and what did market do? Market instantly took out that external liquidity high. Obviously that's very important, because number one, it helps us to identify and indicate that, okay, that's a break of structure, that's a change of character. And a lot of people who were selling previously and were thinking this is just a retracement move were then taken out. So that's very important, that external liquidity high was then taken out. And of course, if you continue the cycle, now we have to start all over. Because once it's been taken out, the point of the area that was responsible for taking out the high becomes our new external liquidity low. Of course, it becomes our new external liquidity low. And obviously you wait for the area where market stops are rallying up and comes back for the retracement, and that's where you identify your external liquidity high. Now obviously from that area is very important. It's very key in terms of saying that as you can see right now, market dipped into the fair value gap, because obviously from this area, from the external liquidity high to the external liquidity low, the only points of interest I can identify is that fair value gap, because as you can see, there's no downtrend or order block, and market is really not gonna take out that area, obviously, because from that area to that area, of course, from that big break of structure to that area to our previous supply zone, that becomes your mitigation block, your new points of interest. So that's another confluence you can add to your external high and your external low liquidity. But obviously in this instance, market then came into the points of interest that were identified, and the market shooted up, pinned a bunch of times. That's very, very important. It indicates and shows that market is trying to accumulate orders from both sides, buy and sell. And as you can see, what market did, market then rallied away, taking out that external liquidity high. So obviously that then identifies us as, okay, market is taking out another liquidity high, because as you can see, why this area was a liquidity high, there were a lot of people who were expecting this to be a fair value gap on the left. The people who had hope, who had hope and were waiting for market to tap into that area and run away, were taken out. So very, very important. They're very, very key. And as you can see, what market did there, from that area of this market resets, we reset our liquidity highs and our liquidity lows. The area that was responsible for taking out the liquidity high is then marked as our external liquidity low. And in terms of looking for external liquidity high, we have to go back to the area that was to the point where market swinged back into the retracement. In this instance, is right there on top. But as you can see, that move as well broke significant structures, of course, indicating possible mitigation, but at the same time broke significant structures. So let's see, in this instance, our new liquidity high, our new external liquidity high and low has been set, and now we're looking for internal liquidity, our positive liquidity in this instance. Now in this time, this one was a bit shifty, because there's imbalance that needs to be filled, but it's gonna be filled later. Market has already begun the filling. But in terms of what we were looking for, there wasn't really a lot for us to look for. I mean, if market doesn't tap into that imbalance, then there's no trade for us. The only way you could have traded that is with the confluence of the mitigation block, but that's not good enough. But obviously, in terms of the trend, market then came back, market then retraced a bit, not going into any point of interest, so there's no trade for us. Market then obviously traded into this fair value gap right after it took out the external liquidity high, traded back into the fair value gap, making that a fair break of structure, of course, trading back into the fair value gap, and obviously that area that was responsible for taking out the structure becomes our new external liquidity low, and our external liquidity high is right there on top at the of course the last swing point. And as you can see, in this instance, the market finally came to a peak formation, to a rest point, to a peak formation high, and market now is already looking for you market is already going short. But in this instance, of course, this becomes our new external liquidity high, and that becomes, our new external liquidity low. That becomes our new external liquidity high. And obviously now looking at the liquidity inside, there was not a lot. There was not even a lot of imbalance that needed to be filled. All the imbalance was filled, so there was not really a lot for you to hope for in the market. But obviously, in terms of what happened here, market then came to this area, gave us a very nice 3-drive pattern information, three pin information. Market then broke structures, of course, confirming that change of character, but at the same time, of course, confirming that is our break of structure and our mitigation block. Very, very important. They're very, very key, our mitigation block. Now, obviously, in terms of points of interest, there wasn't really a lot for us to look for in that instance, break of structure, because market didn't trade into the proper premium zone. Market's currently in a discount, and there was not a lot to look for. The only way you could have traded this would have been trading the mitigation block, which is kind of weird. So the only point of interest I see is kind of right here on top, because I see a bit of a fair value gap right there. Very, very interesting stuff, but we'll see. But yeah, guys, thank you guys for watching. Don't forget to like, comment, and subscribe. Don't forget to hit that notification bell icon. And yeah, thank you guys for watching, and goodbye.